All right, let's dive right into this. Today's explainer is all about JP Morgan's fascinating 2026 mid-year outlook, and we are going to unpack how some massive global shifts are actually going to impact your long-term wealth. We're looking at a world that's basically caught in a giant tug-of-war between profound disruption and some pretty incredible new opportunities. Our goal here is to cut through all the noise and give you the direct, structured insights you really need. But before we map out the broader world, we've got to ask a tough personal question. Is playing it safe with cash actually putting you at risk in this new economy? You see, with inflation running hotter than we were used to in those pre-pandemic years, the gap between what your cash yields and the rate at which prices rise is shrinking. Sitting on a pile of cash might feel like a safe harbor right now, but realistically, it could actually be a slow leak in your purchasing power. So, to understand how we navigate this fragmented world, here is our roadmap for today. We'll start by looking at a new market frontier, then break down global choke points and energy risks. After that, we'll dive into the US-China economic divide, uncover how emerging markets are gaining new power, and finally, map out the path forward for investors. Let's kick things off with Section 1, a new market frontier. We are officially entering an era defined by conditions that are just structurally different from the last decade. Right now, the global economy is navigating this crazy landscape of rolling shocks. JP Morgan highlights that we are essentially beset by the push and pull of contradictory forces. We're talking about everything from geopolitical conflicts in Eastern Europe and the Middle East, all the way to massive, sweeping technological disruptions driven by artificial intelligence. It's kind of a beautifully chaotic picture, and understanding how these things connect is absolutely crucial for your financial goals. Now, here's the crucial takeaway. That old, reliable strategy of holding 60% stocks and 40% bonds, it might no longer protect you when inflation is acting this unpredictably. The report suggests that the correlation between stocks and bonds could now be structurally higher, meaning when one goes down, the other might just go right down with it. These rolling shocks are likely our new reality, which means we have to start looking for totally new types of portfolio exposures.
Okay, let's move on to our first major pressure point in Section 2, global choke points and energy risks, and see exactly how physical geography dictates economic reality.
When narrow physical corridors like the Strait of Hormuz get disrupted, you feel it instantly. It sends immediate price shocks right through your wallet, affecting everything from a gallon of gas to the cost of everyday plastics. Think about this. Roughly 20 million barrels of oil move through this specific corridor every single day. That is a fifth of global petroleum consumption and nearly a quarter of all seaborne oil trade. So when tensions flare up there, a geopolitical risk premium gets baked directly into global energy prices. But it gets even wilder when you compare our reliance on Middle Eastern oil with our overwhelming dependence on a single island for the microchips that power our modern lives. While the Strait of Hormuz handles about 20% of our oil, Taiwan manufactures more than 90% of the world's advanced semiconductors. Over 90%. It is a staggering single point of failure for the entire global technology ecosystem. Just a 5% contraction. If Taiwan were to face a blockade, economists estimate a catastrophic 5% hit to global GDP. That's a shockwave that would literally impact nearly every industry on planet Earth. To put that into perspective, some economic models suggest U.S. GDP could fall by nearly 7%. That is roughly equivalent to the sheer economic devastation we saw during the global financial crisis. The stakes for this specific geographic choke point are just absolutely outsized. Which brings us right into Section 3, the US-China economic divide. This is the broader geopolitical chess match that is currently shaping global capital. We are watching the global economy practically splinter into two distinct blocks. On one side, the U.S. is focusing heavily on domestic resilience, tweaking export controls, and repatriating its supply chains. And on the flip side, China is rapidly building connective infrastructure all over the world, prioritizing tech self-sufficiency and really expanding its influence across the global south. Both of these superpowers are heavily utilizing industrial policy to secure their own strategic futures.
To really wrap your head around this, China invested a staggering $53 billion in Brazil alone in 2025. They are establishing incredibly deep commodity relationships and trade corridors in a region that has, historically, been heavily tied to the United States. And this isn't just about throwing money around. It is about building durable, long-term relationships that reinforce strategic depth in an increasingly fragmented world.
The big takeaway here is that these shifting alignments mean future market returns are likely going to be driven by which economic ecosystem a company belongs to, rather than just its sheer profitability. We're getting to a point where market access, financing conditions, and even baseline competitive standards are diverging based purely on geopolitical alignment.
Now, where there's geopolitical pressure, there's almost always economic promise. Let's explore that in Section 4, Emerging Markets Gain New Power.
Latin America is uniquely positioned to be a massive winner in this fragmented world. Why? Because they hold the literal raw ingredients required for the AI and green energy transitions. We're talking over 40% of the world's copper and nearly 60% of known lithium reserves. Plus, Latin American central banks have proven to be incredibly adept at managing inflation lately. They've established a lower volatility regime that is looking highly attractive to foreign direct investment.
And we are actually already seeing this massive shift happening right in North America, with Mexico suddenly becoming a dominant force. In 2025, Mexico officially overtook China in exports of advanced technology products to the United States. Data center-related exports have absolutely surged there, proving that supply chains are successfully being rewired closer to home, which hugely benefits economies sitting within trusted regional blocks.
But, we really can't ignore Chinese equities either. Despite all the geopolitical friction, the MSCI China Index is currently trading at a steep discount compared to its regional peers. Meanwhile, the country is pumping out 40% of the world's STEM graduates and producing 7 out of 10 generative AI inventions globally. So for the selective investor, this presents a really fascinating paradox. Heavily discounted valuations sitting inside a market that is aggressively leading in AI innovation.
So, with all that being said, how do we actually take these massive global trends and protect our own portfolios? Let's break it down in our final section, the path forward for investors.
The most important thing to remember here is don't panic during market fragmentation. If we look back, history shows that long-term investors are very often rewarded for investing right through geopolitical uncertainty. So instead of retreating to cash and hiding under the mattress, use these rolling shocks as an opportunity to strategically buy into undervalued long-term assets. These market dislocations are exactly what create attractive entry points.
To build true resilience today, you have to expand your definition of diversification. Step 1. Look way beyond just traditional stocks and bonds. Anchor into real assets and alternative strategies that can actually weather sticky inflation. Step 2. Actively invest in the infrastructure powering the AI supercycle. Think data centers and power generation. And Step 3. Add exposure to resilient emerging markets, like Latin America and the Gulf, because they frankly hold the keys to tomorrow's supply chains.
I'll leave you with this provocative thought to chew on as we wrap up today's explainer. As the world enters this completely new era of intense pressures and incredible promises, is your current strategy actually robust enough to thrive? The traditional 60-40 playbook was written for a totally different world. It's time to ask the hard questions about your portfolio, look past the worst-case scenarios, and position yourself for the massive opportunities this new frontier is presenting.